Probably heard over the years and probably talked about a lot lately is when will the Fed cut rates and will that make my mortgage rates cheaper? Not exactly. There's not a direct link. So let's dive into it and clear up some things. When the Federal Reserve cuts rates, what they're doing is cutting the federal fund rate. This is the interest rate that banks pay when they borrow money. This will directly affect credit card rates, business loans, and auto loans, having them all go lower. Mortgage rates follow a different item. They follow the 10-year treasury. That's where they're closely linked. They're not exactly there, but that's what you want to follow when you're following mortgage rates. The 10-year treasury follows things like inflation, growth expectations, and things of that nature. So what would happen though is what you'll see where the connection lies is when the Fed does cut the federal fund rate, typically the market's going to expect lower inflation, more growth, more economic activity, investors being in the market more, which could lead to mortgage rates following suit, lowering with a lower 10-year treasury. I've always said, you want to look at the 10-year treasury, add a little bit to it, and that's kind of where you see where mortgage rates are. So that's where you're going to see the connection. So the federal funds getting cut will not directly lower mortgage rates. It's more like a distant relative that influence each other indirectly spaced out. So you would see a correlation over time. It wouldn't be an immediate effect, and you would likely see the buildup towards the 10-year treasury lowering and mortgage rates following suit prior to a Fed even cutting. A lot of times people expect it to be immediate. It's not. Don't confuse a federal fund rate cut with a mortgage rate cut. Let me know if you have any questions. We're here to help.